You did everything right this month. Decent income, no extravagant purchases, nothing obviously reckless. Yet your account balance is sitting near zero, and you have no idea where it went. Every financial influencer online has the same prescription: discipline, willpower, self-control. But a 2019 Cornell study dismantles that prescription entirely. The average human brain processes over 35,000 decision points every single day. By evening, your executive function is not underperforming because you are weak. It is because the neurological stamina grid that governs impulse control has been completely exhausted. This is not a character flaw. This is cognitive biology. Research out of Duke University established that roughly 40% of your daily actions are not decisions at all. They are automated behavioral loops running beneath conscious awareness. The people who consistently accumulate wealth are not operating on superior willpower. They cracked a different code entirely. They made saving automatic, invisible, and structurally inevitable. A 2021 study in the Journal of Consumer Research tracked individuals who relied purely on discipline-based saving methods. 73% had abandoned their savings goals within 90 days, not because they stopped caring, but because the cognitive battery that powers resistance drained faster than it could recharge. Every skipped coffee purchase, every closed Amazon tab, every suppressed craving pulls from the same finite neurological reservoir. And when that reservoir hits empty, the brain does not negotiate. It capitulates. Research from Chicago Booth added a critical layer to this. The human brain processes visible money and pre-routed money through fundamentally different neural circuits. When a paycheck lands in your checking account and you can see the number, the brain immediately activates mental accounting: rent, groceries, obligations, and somewhere in that calculation, a quiet neurological justification for a small reward. But money that moves automatically before your visual cortex ever registers it? The brain codes it as non-existent. No loss aversion, no allocation conflict, no depletion of executive fuel. It simply disappears into savings, while your behavioral baseline recalibrates around what remains. The first structural tool is what behavioral economists call a Ulysses contract. The concept is pulled from antiquity. Ulysses ordered his crew to lash him to the mast before his ship approached the sirens, binding his future impulsive self to the will of his rational present self. A 2018 paper in Psychological Science found that pre-commitment devices of this nature increase goal completion rates by up to 74%. The practical architecture looks like this. You engineer friction into the path of spending, real time-consuming, psychologically costly friction. Some practitioners freeze their credit cards inside blocks of ice, introducing a mandatory cooling-off window between impulse and transaction. Others remove stored payment credentials from every retail platform, forcing a manual re-entry that creates just enough resistance for the prefrontal cortex to intervene. External accountability, a signed check held by a trusted contact, authorized to cash it. If you violate a spending boundary, introduces social consequence into the equation, and the human brain treats reputational risk with extraordinary seriousness. The second architecture is automation, and its superiority over manual saving is not even debatable. Northwestern researchers found that individuals using manual transfers exhibited a 68% inconsistency rate. In contrast, people running automated systems demonstrated a 94% consistency rate because the decision architecture was built once and then permanently removed from the cognitive stack. Here's the structural blueprint. A portion of every paycheck routes directly into pre-tax retirement instruments before it ever touches your checking account. The remaining capital flows into a central command account, a money router, that automatically distributes fixed percentages into designated sub-accounts. Emergency reserves, post-tax retirement vehicles, and defined savings targets. Bills and recurring obligations are handled entirely by auto-pay, settled on schedule without a single conscious input from you. You configure this system once. After that, it operates without you. A Columbia University study found that individuals using automated financial systems reported measurably lower. Chronic stress and higher life satisfaction scores, because the cognitive relief of not managing hundreds of micro-decisions compounded into psychological well-being. The third mechanism exploits a quirk in dopaminergic reward processing. Stanford neuroscience research confirmed that the majority of dopamine is not released upon acquiring a desired object. It is released during the anticipation of acquiring it. The wanting generates the chemical reward, not the having. This is precisely why a purchase that consumed your thoughts for days feels hollow within hours of delivery. You can weaponize this asymmetry. When an impulse to purchase arises, open a dedicated list on your phone, titled Not Now But Later. Log the item. Your brain interprets this as a commitment to a future acquisition and releases the anticipatory dopamine hit at zero financial cost. Then enforce a 30-day waiting period. If the desire persists after 30 days, buy it without guilt. If it evaporates, which it will approximately 95% of the time, you have satisfied the neurochemical craving for free. A list and a waiting period are not weakness. They are precision countermeasures. The fourth principle governs necessary purchases through the one-to-one rule. You only acquire something new when it is replacing something that is genuinely broken or no longer functional, and whenever viable, the replacement is sourced secondhand. This behavioral constraint dismantles what Cornell researchers identified as novelty bias, the brain's compulsive craving for new sensory input. Sourcing a pure wool coat from a consignment shop for a fraction of its retail. Price is not a compromise. It is an arbitrage. The one-to-one rule converts every potential purchase into a utility audit. The fifth strategy closes the gap between what you believe you spend and what you actually spend. University of Chicago research found that people who categorize their spending save 21% more, because categorical visibility dismantles the planning fallacy, the cognitive tendency to underestimate expenditure and overestimate available capital. Map your cash flows across 4 domains: capital, core needs, choice spending, and compound allocation. When the actual percentages surface, most discover their assumptions were significantly miscalibrated. This is not a moral failure. It is a data failure, and data failures have data solutions. The sixth mechanism is the quarterly leak audit. A 2022 behavioral finance study found that consumers estimated their monthly subscription expenditure at $86, but the actual figure was $219. 42% of participants were actively paying for services they had entirely forgotten existed. Every 90 days, export your full transaction history into a spreadsheet and isolate recurring charges. Interrogate every line item, cancel the dormant, negotiate the essential, and contact your bank directly to contest fees. Princeton researchers calculated the average annual leakage from forgotten subscriptions and passive fees at $720. That is a functional savings contribution evaporating silently every year because no one scheduled maintenance. The seventh and final instrument is habit stacking. Attempting to introduce standalone financial habits requires building entirely new neural infrastructure, which demands willpower resources that are finite and depletable. Habit stacking bypasses that entirely. You identify an existing automated behavior like morning coffee, preparation, or nightly dental hygiene, and you attach a micro-financial action directly to it. While the coffee brews, you open your banking app and review the prior day's transactions. After brushing your teeth, you transfer a fixed amount to savings. 30 seconds. Zero new cognitive load. Stanford research found that this piggybacking method increases behavioral adherence by 67%, because you are running on existing neural rails, not laying new track. And here is the final mechanism that binds all 7 together. MIT research established that individuals who allocate savings the moment a paycheck arrives, before bills, before groceries, save 31%, more than those who reserve whatever is left. Because there is never anything left, expenditure expands to consume whatever capital is visible. Move the money before your brain processes it as available. You are not failing because you lack discipline. You are failing because you are using 19th century behavioral prescription against a 21st century commercial infrastructure that employs neuroscientists to defeat you. The individuals accumulating wealth are not different from you in character. They stopped fighting their neurology and started architecting around it. Automated the right choices, engineered friction into the wrong ones, gamed the dopamine system, built accountability structures, audited relentlessly, stacked micro-habits onto existing neural grooves. Now here is your only assignment. Do not attempt to implement all 7 of these simultaneously. Pick one, the one that requires the least activation energy to begin today. Maybe it is scheduling a single automatic transfer. Maybe it is opening a not now but later list right now on your phone. Maybe it is pulling up last month's bank statement this weekend. One strategy, one action, one starting point. The goal is not to become a different person. The goal is to architect an environment where the person you already are cannot help but build wealth.